Good afternoon, dear colleagues. Thank you for accepting our invitation. We would like to submit your monetary policy outlook. The board will be represented by Deputy Governor Hovhannes Khachaturian. Mr. Vazgen Pavosyan will make the presentation. We're also joined by Harutyun Sarkisyan, macroeconomic policy expert. You can ask the questions after the presentation by introducing yourself. Thank you. One more time, good afternoon. I welcome you at this platform. Thank you for the interest you have expressed. As always, here is the content. We'll start with general economy, domestic and global locomotives. We'll speak about the baseline conditions as to where the economy is and what are the scenarios that the board has deliberated on in making its decision. Illustrative, conventionally A and B type scenarios. On reflecting on the global environment, let's start with the US again. In the US in 25, the economic growth was quite volatile. If we look by the quarterly breakdown, considering the transformations and rethinking of their economic policy, along with this volatility closer to end of year, the growth rate of the economy significantly slowed. In Q4, economic growth was 0.7%. This is annual Q over Q. Moreover, if you pay attention, according over there, 1.4 initial assessment. Last Friday they reviewed 1.4 down to 0.7, which is quite a big revision. This comes to prove that especially external trade and the change in stock is difficult to assess because uncertainty in those flows is great. In Q1 26, maybe the growth might have accelerated. It's 2.7 GDP assessment as of March 13, but here again there is quite big uncertainty. We'll see how it goes. On the other hand, if we look at some other sector indicators, labor market, for example, the number of layoffs in general, the change in the number of the unemployed and the unemployment level, we receive certain signals also that the total demand conditions are weakening, which is noticed. On the other hand, it's also noticed if we look at the financial sector, the NPL weight is the top right graph. Especially credit card products weight has increased significantly. It's gotten to the indicators levels of 20.078. Car loans acceleration increase and so forth. On the other hand, if we look at what is in this 0.7, there is private consumption that has a big chunk of 0.7, which is remaining the main driver of economic growth, although it's also slowing down, but it still remains the main driver of economy. Maybe it sends signals upwards domestically. If we look at the inflationary developments on this background, if we look at the core inflation measured by CPI, it's 2.4% as of February, which is pretty close to their target, which is 2%, but based on PCE long-term CPI is 2.3 to 2.4, which is in tune with PCE 2. So it's pretty close to target in these terms, but the Sticky prices indices for services continue to remain quite high. We have to say that in external trade policy risks, the tariffs related also have some risks that maybe some part of it is not yet reflected in the inflation and may still impact the increase in tariffs, the inflation. In these conditions, in this environment, as you know, recently the situation, the tension drastically increased in the Near East, which first and foremost reflected on oil price increase. As you know, the Hormuz Strait gets through a big chunk of oil supplies globally, and so the oil global prices have been affected. Usually for the American economy, the increase in oil prices has a negative impact on economic growth, usually, because the input costs for the economy increase. But on the other hand, it also has inflationary impact. Depending on the scale of the confrontation, the impact may be quite significant on the American economy. This is illustrative. One example, one of the Fed press, but the amount of impact is pretty divergent. But in terms of vector, in academic literature and research, there is no difference. We get more or less this type of impact expected. And when we look at the de facto impacts at this point of time, the fuel prices, petroleum and gasoline prices in the top right is a weekly, week over week line chart. We already have 15-16% of increase in prices at filling stations, which is comparable to the peak of weeks of March 22. On the other hand, there is another important circumstance that may indicate that this time the shock may be easier absorbed by the economy, because the total expenditures of households on petroleum in the total disposable income has been pretty low, as of 2.3%, which is historically low. On the other hand, the midterm and long-term risks that have existed in the American economy persist. In particular, the financial markets, notwithstanding the recent adjustments, still have overpricing risks. The PE ratio price, expected yield in 92 2000, the peaks are pretty close to these indicators, so this means it's overpriced. And the real estate market within the recent period also has had significant weakening. The real estate prices went down. This could affect the overall consumer sentiment, and have an impact on weakening subsequently the demand. On the other hand, A-type risks also exist. In particular, the midterm sovereign debt trajectory is associated with risk. As you know, recently in the United States, the judiciary deemed unlawful the sanctions imposed by the American administration, changed its nature to some extent, but the risks still persist about the the collection of the of the adjusted tariffs, as well as maybe the possible return will be pending of the already collected tariffs. And an additional factor is this Near Eastern conflict, which America is spending significantly on, which is essentially unplanned expenses. And the impact of these two factors may impose additional pressure towards increasing the sovereign law trajectory midterm and long term, which may also impact the neutral rate in America. That is, the risk premium will may be permanently higher. All of these developments considered, the US economy, if we look at it, the financial markets have reviewed their expectations. The Fed monetary policy wise. In the top right graph, prior to the confrontation, is the dark blue curve, and the yellow is the post conflict, that is last Friday or Thursday. And you see that the curve has been revalued upwards. For this year, in the past they were expecting 2 steps of reduction. They now expect about 1 step downwards. On the other hand, something that may be even more interesting, the lower right graph indicates that if in the past, prior to the active flare-up of the confrontation, the financial markets essentially were looking at 2 options: low likelihood of reducing by 25 base points and about 100% likelihood to leave it unchanged. Whereas now it's about 11% of the market players expect an increase by the Federal Reserve System. So the distribution of expectations has shifted right ways. In the Eurozone economy, the low economic growth rates persist in view of continual persistence of their structural issues, especially in the processing industry. For example, last time there were signals about, if we look at the right graph, of their processing industry. These are the new commissions in the processing. There was significant acceleration and growth, meaning that their fiscal incentives of infrastructure development and security infrastructure development in particular had a positive impact on the processors. But it rolled back within the last month, and there's still great uncertainty whether these fiscal incentives are sufficient to resolve the structural problems. In this environment, the Near Eastern developments, the flare-up in the hostility, may have an even bigger detrimental impact on Eurozone economy, considering the already existing structural problems, especially in the processing industry, as well as the fact that the energy system in the economy, and then the fuel supply, retail, and the economy in general are greatly dependent on oil and LNG imports, especially considering the fact that in the gas holders are filled very low to their capacity, about 30%, which is below the average of the 5-6 years. Is close to the minimum. So the inflationary pressures could be much higher than in, let's say, the United States or other developed countries. So under these conditions, the ECB faces serious dilemma going forward. Short-term inflation, economic growth, the economy has to be effectively managed. The Russian economy, also within the recent period, we observe the rate of economic growth continuing to slow down or stabilize around 1%, 0.6 to 1. And here again, whether the general demand or prospects of economic growth receive weakening signals both in the from the lending market, from the labor market. These signals emanate. If we look at inflation, although inflation is still higher than their target, if we look at the acceleration of inflation, especially within the recent months, month over month annualized, it's already hovering around the target indicators, which means the central bank was gradually weakening monetary policy rates. It's around 15.5% now, as opposed to the US and Eurozone. We'll talk about China as well. Maybe in Russia these impacts could be somewhat different, considering the net export of petrochemicals and their significant chunk in the economy. Comparison of Brent and Russian Urals. The difference has shrunk. In the past it was 20 up to $30 in February, even more at various days. Now the discount is about $1-2. There were even days when it was positive, the discount, which may result in Russian galvanization, positive impact on economy and demand. But one needs to also consider that on the background of recent sanctions, the mining volumes have shrunk, and on the background of high growth in the economy, the total petrochemical weight has somewhat shrunk in the economy. Still pretty high, 10+%. In these conditions, the Russian central bank, the financial markets expect from the central bank gradual policy rate reduction, but both A and B type risks persist. The Chinese economy, we continue to observe weak domestic demand or subsequent weakening signals. On the left graph, the economic growth indicators, and the dotted line presents their target of economic growth. You know, the party sets targets there. During their last convocation, they reduced the target. It used to be 5, and they now stipulated it 4.5 to 5. So they gave a certain brackets towards sending a signal toward reduction. If we look, this is essentially determined by continuing structural problems in the real estate market, which persist. Inflationary environment is still weak, and what matters here is that the Chinese economy perhaps is somewhat less vulnerable to the active hostility in the Near East. Their supplies don't seem to be disrupted, and the prices, of course, they're buying at higher prices. What matters here is that in the total energy infrastructure of the country, the weight of oil and natural gas is lower than in other developed countries. It's about 25% of the economy, and in the recent years they increased their renewables share 7.5, and you name it. In these conditions, they could use this additional competitiveness gained over the global economy, and maybe there could be developments of increased growth or demand. The oil-like shocks don't have a big impact on the total economy, but if you look at the top right graphs, this is the producer prices in gray curve. These are the ones that we import for industrial products mostly, and we see there are certain risks still persisting towards growth. If we draw parallels with the events of 22, they could be close in absolute terms, about 10-15% of an increase in producer prices. But there were shutdowns in view of COVID back then, which could have highlighted the situation more than just the oil price impact. As for commodity markets, one should acknowledge here that in particular volatility and increased prices are observed in the oil market in view of the role of the Near East in the global economy. The left graph provides for total release, and the part that goes through Hormuz Strait, out of 25 billion barrels, about 15 out of Near East countries goes through Hormuz Strait, which accounts for about 15-14% of the global total. In the right hand graph, there are four curves. These are scenarios. The first, the lowest curve, is EIA's forecast for 26 done in February, on February 12 or 13th in their monthly report, where they expected gradual reduction down to $55 by the end of this year, give or take. The line above it, the dark red, is their forecast of March 12, annual forecast. For the year, their expected price on the average is providing for an increase of about 40% annual. The two more lines on top of it are essentially our assessment, capturing the risks that the confrontation may on the one hand last much longer than what EIA expected. They expect this month or in the coming months the confrontation active phase to die out. This scenario number one reflects that, but the second one reflects the expansion of the confrontation both regionally and, for example, we get news about certain oil infrastructure being damaged and subjected to strikes. And if these incidents increase or expand, that is, the confrontation deepens, the supply will structurally shrink, and even if the active phase is over of the confrontation, it may take a lot of time until the supply volumes get back on track. On the other hand, in the food markets, the developments, if we look at the monthly data, the impact of the conflict is not yet visible, but on a daily basis there are clear signs not visible yet of the confrontation. But for certain goods, especially the food stuff that, for example, could be used as an alternative for fuel, biofuel, they could generate from some food stuff, they correlate to oil prices, and we could see trends of increase. In conclusion of the external developments, There are two important things. One, that we see in our main trading partner countries, there is clear signs of slowdown of growth and demand. And the second, which may be even more important, there is worsening of the prospects of growth, especially considering the Near Eastern developments. The subsequent significant risks of slowdown in global demand. On the other hand, there is also certain inflationary risks to be important. As for our domestic economy, first and foremost, speaking about our euro bonds, what matters here, the yield and the assessed risk premium wise. Notwithstanding these risks, their impact on our risk premium and the yield level is has been quite low. In the right graph, we see the spreads. Some countries in the broader region compared to ourselves, you'll see that in general terms, we are close to the average regional. About 20 base points increase is what we can talk about after the start of the active phase of the conflict. If we look at the similar historical developments, the same Israel or Iran or other confrontations, usually the response is much higher in our yield and risk premium than now. This may perhaps indicate that our security risks are somewhat weaker, which is what we talked about in the past. The rate of economic growth has accelerated significantly. In Q4, it was 9.8%, which in annual terms means we will have about 7.2% annually. The main contributors to growth continue to remain services, construction, and processing industry. Although the processing industry especially has quite increased volatility in growth recently, determined by some non-structural, the base metals subsector, which are mostly important exports of our processing industry. A similar situation was observed in 24, in Q4 23, Q1 20, where the release has increased 45% year on year. Mostly base metal or jewelry was responsible for it. Initial assessment is that there was 31% of increase in VAT that our statistics colleagues have assessed. Then it was reviewed downwards. It went down to 9 from 31. Maybe there is similar likelihood at this stage as well. There was 33% of increase in growth. 10.5% of increase of VAT was accompanying it, but by various estimates, maybe this growth should have been more modest. So there are certain risks here. There are certain risks also following the logic of the extent to which this assessed VAT growth is reflecting real growth along the developments in ICT sector. The information collected expanded according to the companies. Maybe some part of this growth, especially in the first half of year, may be reflecting the impact of completing the statistics rather than the growth in those sectors. But in any case, even if this were a possibility, and considering those issues, the growth has been pretty high, one may say. And if we look at 26, in terms of continuity, the economic activity indicator in January was also pretty high. If you look at December, 14% in December, it got down to 6.6%, but that was mostly determined by non-structural foreign trade or service provision factors. If you look at the right-hand side, processing industry from 36.40 in growth in November, December went down to 4, which was grossly determined by this re-exported goods flows. Gold, platinum, silver, especially weakened. The top right graph. In December, $500 and more of trade went down to about $50 million. But in general terms, if we look at, although there was certain volatility and weakening signs in January, in Q4, nevertheless, the sector had some solid growth by subgroups. January decreased, but it's just numbers for 1 month. And we'll continue to keep track on how long will this still be reflected. If we look at the risks of the possible impact of Near Eastern development, especially on our processing industry, one has to say that notwithstanding the general industrial goods towards Middle East and Southeastern Asia, and in particular Near East, our exported goods account for 10 plus something goods, but for some individual products like tobacco, there's a big weight. Iraq, Syria, UAE have pretty big share of our supplies. But we have to say that we still do not have signs of systemic disruptions, but if the confrontation continues or deepens, those risks naturally will exist. ICT still continues to preserve dual signals, notwithstanding certain statistics. Once the impact of statistics being completed, the effect weakens a little, but it still displays so sound growth, 8% or around it. If you look at other qualitative indicators, increase of employment in IT, increase of the wages growth, it was close to zero within the last 2 years, which may indicate the opposite. Maybe this growth is either overestimated or there is serious over-concentration around a small number of companies. There's issues with inclusivity. But if you look at the lower side graph, it's the transfers in the IT through banking system. And the volumes we see, we have growth here, which is in tune with the high growth rate. But once again, there is inclusivity and other risks that persist. On the other hand, if we look at the demand side in the economy, we see that especially in this acceleration of growth, especially in second half of 25, the services significantly contribute to the growth, especially some subsectors in services. Let's say, I'd like to draw your attention to the fact that notwithstanding the total growth of services, it's 7.4 in January, but in conditions where the financial sector issue from December 7.5 turned into 1.7, 12-month growth, which is grossly contributed to by acute decline in forex transactions, exchange transactions, which has 20% weight. Without this sector, the growth would have been here much higher, and it's broadly distributed between subsectors. Speaking of which, the professional, academic, administrative, professional services, culture, leisure, HoReCa, these sectors that have significant acceleration of growth expressed of late, they mostly are determined by expansion of demand in the economy and can attest, and I've talked about it, can attest to the internal demand conditions somehow increasing or expanding. And if we compare developments in this sector with particular commodity groups, inflation, we see acceleration of inflation along certain components, which may attest to the fact that essentially there is conditions of growth increasing, rising. Another sector which contributes significantly to economic growth is construction. Notwithstanding a certain slowdown of growth rates, 18-20% growth level is what it stays at. On the other hand, when we look at the significant risks here, especially if we look at the natural adjustment of prices, the possible slackening of the demand and its impact on consumer sentiment, we must acknowledge that the risks have been somewhat mitigated considering the development in construction through the year. On the other hand, like I said, and we discussed about the demand environment being high and the possibility thereof, and the signals indicated that. On the other hand, if we look at the sticky prices as goods and services inflation, there is some acceleration there as well, but it's still forming around the 3% target level. And there are certain signals from the other side. If we look at retail increase, which is pretty weak, or imported goods for our own consumption, because purged of re-exports. So there is slow growth there as well. These are signals that allow us to talk about the economy being closer to a balanced position, to an equilibrium, than what could have told us about higher demand condition. External demand wise, end of last year, one may say our tourism influx has accelerated, which persists in the first 2 months this year. There was significant growth in January. In February, it went slackened. Year over year, there is 2-3% growth. January, February, we have normal growth, but there are risks here as well, especially in view of the Near Eastern developments. If these risks we can break down these risks into 3 groups. Not the risks, but our tourism flows may be broken down into 3 groups. The first is Southeast Asia and Near East tourists flows, which were mostly taking advantage of UAE air hubs or Qatar carriers and infrastructures, and considering the security risks in the region, these flows may somewhat slow down which, without considering Iran, which is also a regional country, the influx of tourists from these regions accounted for 8%. So there is some vulnerability, but not high. The other part was from the Western Hemisphere, United States, EU countries, where from most of the tourists were our compatriots, but still from this sector, considering our regional risks, there may be more cautious attitude towards traveling to Armenia. This segment accounted for about 15% of our tourist flows. On the other hand, we should also look at the Russian economy. The Russian tourists account for the largest chunk of our tourists, 40 or more according to which month you look at. So there's been about 3.5 million tourists that went to Near Eastern countries, mostly UAE, and when this direction became more risky, perhaps Armenia could be looked at as an alternative for destination. Questions, let's save the questions for later. I want to say that the risks are two-sided and not as definite. On the other hand, the fiscal policy wise, we should say that the demand has an expansionary impact and the risks thereof have increased this year. This is determined by the introduction of universal health coverage, which has certain risks, especially that constrained demand in the recent years has resulted in expenditures this year being more than planned, and another is also the pension and other social expenses increase. Here essentially the risks are determined by sources of funding. Essentially, if you look at this zero point 0.2 to 0.6 vector, this is especially determined by the fact that these scenarios, these expenditures will be done on the expense of additional collection of revenue, using also the provisioned funds to some extent, though there is no scenario of increased deficit. Maybe the risks go in direction that perhaps those revenue may not be collected as planned. But as of this point in time, the clear materialization of these risks have no signals yet, whether from the universal health insurance side or the second type of risks are mentioned. In the labor market, we once again see that the private sector wages are increasing and it persists at about 5% of late. About the last 2+ years, it's hovering around 5-6%. Unemployment continues to decline, getting close to the level of 12 years. This is Q2 data. The data of 25 is published quite late. The uncertainty goes along two directions here. Where is the level of unemployment that will still not yield inflationary impact on the economy, especially judging from the wages increase? We may still say we're in that environment, and the conditions in the labor market are balanced or close to it. On the other hand, statistics-wise, there is certain uncertainty still as to whether the growth in jobs genuinely reflects newly created employment, or is it the movement from informal to formal sectors. And in the labor market, there may be another risks in the labor market, in that, in the context of developments in the Near East, if you look at 22, 23, when we had clearly expansion of external demand shock, we had an expansion of total demand. There was a significant influx of Indian citizens to Armenia, which mitigated the wage increase risks, having a negative impact on the inflation. So the inflation didn't increase that much. The risk may be that as a result of Near Eastern developments, this influx of labor workforce may be somewhat restricted, especially those originating from India, and maybe a similar demand increase or a similar scenario materializing may have an inflationary pressure that is higher on the economy, on the policy. In the recent period, the total inflationary environment acceleration continues. As of February, 12-month inflation was about 4.3%, and the total was natural was 4.3. This continues to be determined also by the great impact of imported food products. In the right-hand graph, notwithstanding the international commodity markets starting from middle of last year, the weakening of food price increases, there was even some slump in the food prices, but maybe in our economy these external prices have a certain time lag in the domestic market responding to it. We fall behind. So in February, the imported food, which is about 15% of our total imports, we had about 10% inflation increase in prices. But there is uncertainty in risk. Maybe it's not only the time lag. Maybe we should already see an uptake, or maybe this is the result of a high inflationary environment in our economy, which is why we don't see those adjustments. On the other hand, if we look at the total inflationary development, especially the natural inflation, if we look at the momentum acceleration, quarter over quarter, it's already closed in February to 6%. And recently we also see here that this inflation, if about 6 months ago it was determined by several commodity groups, we see that now it's becoming more universal and proliferant, this type of inflation, covering more product groups. And we have certain risks here, inflationary risk, for example, in view of the Near Eastern events, there are essentially risks, like I said, and we view this along 3 dimensions. For example, about 40% increase in oil prices, how will impact the economy and the inflation here, which may both directly and tangentially have an impact of 0.6 to 0.8 percentage points. The fact that the Near Eastern or Iranian supply routes being impossible, by opting for other supply routes, the import markup may increase. In this case, it will have the impact of 0.5 to 0.8, and especially if the food imported from Iran is replaced by imports from other markets, it will be 0.1 percentage point of impact. So risks associated with this developments is 1.2 to 1.7 percentage points, and these are naturally risks that we will have to depend on the developments in the conflict. But this essentially ignores the partner countries or global demand environment weakening risks, or even domestic demand environment weakening risk, which may naturally have a mitigating or other effect on the inflation. On the other hand, if we look both at the wages in the private sector or sticky prices indices in long-term stable level, or the direct household survey results, or other yield curve developments, other indicators of the financial market, all of these combined allow us to claim that inflationary expectations continue to gradually stabilize towards the target of 3%. Alongside all this, we should say that, and both the preliminary conditions in the market are in tune with the scenario of financial market expectations. Essentially, they're originating in the signals that we are receiving. One may safely claim that the economy, notwithstanding small, somewhat higher demand, is close to an equilibrium. And whether the real exchange rate, maybe the market estimates, and the policy position assessments are also in tune with it, and we may say they're close to the point of equilibrium. The real exchange rate, there are certain uncertainties pertaining to whether it may be overestimated or underestimated, depending on the fundamental nature of its fluctuations. The uncertainty is quite high also around the neutral, every component contributing to the neutral rate, whether expectations or the real exchange rate or the neutral rate in the United States, or whether our risk premium fundamental level. Uncertainties persist. Market expectations, essentially, this is derived from our financial market participants, the questionnaires that we circulated among you. Over last quarter, the expectations did not significantly change, and financial markets essentially are expecting an equilibrium to form. Economic growth around 5%, which essentially may decline towards 5% and will persist close there too. And inflation, which in midterm will be hovering around our 3% target. And in these conditions, the market expects that the central bank will continue its monetary policy towards decreasing the policy rate down to 6.25. This is somewhat lower than our expectations of the past quarter. Our most recent questionnaire, the previous one was macroeconomic quarterly questionnaire, and this one was a shorter questionnaire which we circulated especially around dealers, what to expect in the next 8 months. The left graph is the survey of banks, and we see that the commercial banks expect this level at 6.5 to persist longer, and we may maintain the policy rate longer, and we'll have one reduction by the end of the year instead of the June 1 that was expected. If we look at the changes in market expectations in the EU and in the United States, we see that the financial markets there as well have revalued their expectations to some extent. The right graph axis shows that 0.5 or 1.1 is encompassing a full step, which is 0.25. 0.5 is 0.125 basically percent. If we try to derive from yield curves what the market expects from our central bank policy, we see that if you look at the right graph, throughout last year, especially in the second part, our yield curve has significantly declined, and we already talked about the contributing factors. Let me talk about the changes prior to the conflict and especially after it.
The gray curve is the market expectations derived from profitability curve February, and the term premium has been removed. So essentially, you can see that on the 5th of March, compared to February 27, about 20 points difference. I mean, you can see the smaller curve. So here, when discussing our scenarios, the board, in fact, has been discussing several scenarios, members of the board. First signal you might be getting here is the scenario taxonomy growing, just because of geopolitical uncertainties globally. But if we go group by group, I'll try it going faster. Obviously, this is published, and you will see the details in the report. So, demand growing scenarios here, a couple of such scenarios with the neutral percentages. Some rates uncertainties are here. There could have been certain risks here, both in cyclic and stable predictions, like Middle East, fiscal policy being bigger for the near term. Well, there are uncertainties regarding the Russian-Ukrainian war, the sanctions, the longer duration thereof might support capital flows towards our economy. Because of some more significant uncertainties on the international market and global disbalances might contribute to these capital flows going to some other developing countries just because of the inflation risks. This is what the scenario is about. Some scenarios related to higher demand locally than the market expects. In fact, market participants, per our assessment, I mean, you're obviously sending inquiries looking into neutral or close to neutral demand curves in our economy. These risks are both related to the preserved inflation, prices growing, and consumption, and savings that have been amassed may still be used in our economy on the one hand. On the other, the fiscal policy is a factor you will have to look at, maybe possible expansion of the external demands with all the scenarios and risks. There are some other risks deriving from the natural inflation and maybe have some side effects given its more or less global implication. Some scenarios also related to disruption of some value chains in the Middle East, and these are more into the restraint of the supply, and supply chains towards Armenia are disrupted. Some other paths, other routes that might become more expensive for Armenia, etc. Some other risks in case of weaker demand, restrained demand, specifically in consideration further slowdown of the global economy that has been already noticed by China and the European Union, and lower inflation is the consequence of that in those countries. Also, the risks from the American economy, the financial assets price adjustment related, and other risks. Well, I'm not going to be listing all the scenarios. This information is in our report. I hope you had the time to review. And the illustrative IF type risks that this time we've decided to communicate. And these A and B type risks, they're just accidentally selected scenarios and might not have that weight in the decision making. So the A-type scenario, in fact, reflects the risks related to high economic growth we're currently witnessing, and the consumption growth has been significantly contributing to this growth. Like in the fourth quarter, there's been 9.8% growth, of which 0.8 has been consumption, which is quite significant growth. So if you compare all these to the accelerating inflation and for the 12 months and some accelerations in the last several months, maybe the demand in the economy is quite high, and maybe financial markets underestimate the demand per se in our economy. So maybe that also tells the central bank that we have to be stricter in our monetary policy. And this is something that emanates from this scenario. There's a consolidation of macroeconomic scenarios that might require a bigger trajectory than the markets may expect at this moment. You will see the chart. The next scenario is related to the base scenarios of the risks. I mean, you'll remember, after events of August 8 last year, you'll remember we have discussed this. And we're also following this chart on the right side. We've been following the trends of generally developing economies, but after 8th of August last year, the risk payments have dropped compared to the average in the same group of countries where Armenia is. I mean, there are 25 basic points, and that reflects the extenuation of the security risks of ours. And some rating agencies' results showed that. Fitch or S&P, the perspective of the sovereign rating of Armenia moved from stable to positive, which is in fact a great foundation for improvement of the rating in the future. So per different assessments, 1 degree, 1 point improvement there might be 0.75% of impact on the risks. And this scenario is just another factor, another signal that financial markets would consider this scenario, move in this direction. And we've been seeing significant inflow of capital in our economy, I suppose, due to that, and towards the AMD bonds, foreign players purchasing Armenian bonds. So last year, the overall reserve of non-resident investment in AMD bonds comprised an amount larger by 100 billion Armenian drams compared to the previous year, reaching 10% of the total reserve by January 2026. So they were there, comprising about 10%. Maybe this also asserts of that. maybe this also means that the terms of the monetary policy currently are stricter than the financial markets would find them. Maybe the neutral rating of ours is lower, could have been lower in the longer term. So in order to manage the risks beyond this scenario, specifically falling price risk, because stricter policy would obviously result in these risks and materialization, we might need a lower trajectory of credit interests. That's it. Everything I wanted to present. Thank you for your attention, and if there are questions, I'll be happy to answer. 2 words to start with. Thank you for being here once again. In similar situations where there are threats to the global economy and local economy, this format becomes even more important. We try to be as open as possible. So this whole envelope of information is being presented to you. But we cannot divulge classified information. This week, many central banks are going to be changing their rates, and we've been following the communications from the latter, and I'm sure you have been following that too. So this is the part, this is the period of time where it's important to understand the risks and listening to one another. Questions? Thank you. Georg Nalbanzyan, G&L Invest Director. My question is related to the events happening in this region, the war specifically, and issues pertaining there too. So 3 years ago, when the Ukraine-Russia started, there was a significant influx to Armenia. About 100,000 refugee/tourists came to Armenia, and as regards the cases in Iran, any forecasts there? How many refugees are we going to receive? Will we provide for food security? Because everything is now a little more real than it was when it was Russia-Ukraine. So will there be refugees? Are they going to be staying in Armenia? Are they going to be going to Georgia, Russia, Europe? I mean, that's the only route. Okay. I cannot dwell on details with logistics and security, that there are refugees transiting through Armenia, food security, etc. Well, naturally, we have been considering some probabilities, made some estimates. At this moment, we don't see big reasons for their materialization. We don't think these things are possible. We haven't advanced yet into some numbers and scenarios and how many people might come compared to 22, how much estate they have, how much money they're going to bring to the banks, etc. So naturally there will be some people coming to Armenia. Of course there will. But I don't think that it's the same magnitude as in 2022, or at least we don't have that much information. Not that many border crossings yet, and neither any border crossings for the purpose of transiting through Armenia to other countries. So no information, meaning it's not yet happening. Another very interesting and important point, as Vazgen just said, it's the perception of the risk level of this region and where might the capital go, because it's not just the citizens of Iran. There are foreign nationals in the United Arab Emirates, Armenian nationals in United Arab Emirates, certain numbers of people, probability of repatriation of Armenians. Supposedly, if this war lasts, then we might start doing the estimates in more detail. Okay, just 2 points to add. You know, as regards Russia, the Russian economy, obviously we had deeper connections, meaning economies were more deeply intertwined than with Iran. Well, of course, we have a land border with Iran, we don't have one with Russia. Apparently, that's where your logic goes. But in terms of capital flows, our economy and Iranian economy are not that close. In terms of capital flows, it's very difficult to move capital from Iran, in fact. So I'm trying to say that there are certain risks, but magnitude-wise, I suppose these impacts might be weaker than the ones with Russian economy. And the second, we spoke about capital flows, labor force, human influx. Well, there are certain risks here as well, but I have to say that not at the same scale, not of the same volume. However, the 12-day conflict in summer between US and Iran showed what the situation could have fallen into. There was certain growth in our economy, identified, registered, which was small and very short in time. So looking forward, we may agree with certain risks popping up, but we have to see certain signals to sit down and do the estimates. Thank you. Ignat Frankian, C quadrant. Ampeka, tell us please this 120, 170 base points impact on our inflation. Well, the main scenario is that the conflict will go longer till the midterm elections in the US, supposedly, and to various estimates, there might be 80 to 100 basic points impact on other economies. In case of Armenia, which is in this region and better linked to other countries with other risks, not oil-related, impact could have been bigger. What is the scenario here? Please tell us. And the next question, we have inflation higher than the target already. Significant economic growth at the same time, and this is growth emanating from demand. So I'm trying to understand the scenario. To which point will the inflation go till the board of the central bank does not tolerate it anymore? And then there will be majority on the board to adhere to more restrained policies. Okay, I'll take the first part. Mr. Khachaturian will answer the second. Yeah, Mr. Khachaturian will take that, yes. So as regards these estimates, this is what I can tell you. There are three main paths, three main scenarios described here of what might happen and what are the primary impacts upon our economy. First is the surging oil prices in the world. So we're looking into 40% average price growth here. 40%. And we have also taken as the basis the assessment of the IAEA, the International Atomic Agency. And through the year, there might be about 40% of growth, the prices of oil, according to IAEA. And that's definitely going to be impacting our fuel markets and energy markets, and transportation is definitely going to play a big role here. And respectively, the prices will grow in the markets depending on oil and gas. And of course, compared to developed countries or a number of countries, because natural gas is also on stock markets, all the prices are immediately identifiable. And there's been significant growth in prices, by the way. The Armenian economy doesn't bear that risk, essentially because gas prices are in our contract, and there will be no impact on Armenia in this regard, supposedly, of course. So we haven't taken that into account, haven't factored that. The impact of 60 to 80 base points, well, only in this subsector. Second probability, to different estimates, 30 to 40% of all the imported goods might be impacted because they are on that route through Iran, through Middle East. So 30-40% of our goods. Though we have not yet been seeing any probabilities of disrupted food chains, supply chains, meaning if these paths do not work, these routes do not work, and risk premium grows due to transportation or insurance prices going up, then we might look for other routes like Georgia and over the sea. And it's definitely going to be more expensive and longer. Transporting these food items through other routes might have 60 or 50 to 60 base points impact on us. Next, import from Iran in the total share, into total basket is 7-8%. Well, food import is important because for the others there are no signs of disruption observable at this moment, but there have been certain restrictions applied. And given the share of foods from Iran in the total basket, I mean, it's tiny, really. It's quite small. Replacing it by foods from other countries, well, we have calculated that by units of food items, and there will be about 0.1%. So these were the three main vectors that we have considered. Meanwhile, looking into possible aggravations of the situations in Iran, in the US, in Europe, and inflation there, growing prices. These might be consequence of monetary policies of other countries. Might be also because of our monetary situation. Thank you, Vazgenjan. 4.3 inflation for 12 months. That's what we have. Natural is growing. We have also hard prices growing. Different metrics have been considered. So naturally, we don't have any figure deviating from the target so that I can do the sum up and say what the situation is like, the target plus delta, etc. No, the most important thing for us is the expectations of the inflation, and our inquiries are quite fresh because we've seen such expectations, and it is truly very important for us to consider the one-time change in prices, like because of increasing the transportation of cargo prices. So we're hoping that they do not transform into inflation. As for estimates of in-house demand, well, I mean, it's a matter of weights of arguments and where the balance is going to shift. So in certain areas there is concentration, meaning economic growth is a big number, but there is re-export, the financial share is big, the construction is something that should be observed in a cycle. That cycle matters because there is a return of the income tax, right? And many are into this with the mortgage contracts. So these are the ones we take into account. It's not just an absolute figure we're looking at. And ultimately, the recession risks of the global economy, geopolitical risks on the other hand, that might ultimately result in inflation in the whole world, and Russia and the US and inflation was extenuated to a certain point, mitigated. So all these probabilities dictate the dynamics in the development of this situation. We've been looking, and we will be looking on this round by round. If we're going to be seeing any anchoring risks, we will be very determined here, and the 3% target will be safeguarded very consistently. Questions? No questions. Edgar Nahamekyan, Artbrook Investment Company. So we, before your decision, we saw the expectations of the market players. But since we sent the inquiry also after the decision is approved, I just wanted to check whether anything has been changing. Has your decision impacted anyhow the level of expectations of the market players? Because in the bonds market, there are some signals of change by the numbers of transactions concluded or the rates plummeting. I'm just trying to understand whether your decision has anyhow impacted future expectations. Thank you very much for this question. Very important one. Just technically, we circulate the inquiries after approvals, so I don't have the results yet, meaning I have not yet been receiving any answers. But you may also tell us your expectations. How is the situation impacting your expectations specifically? Would be a great deal of information. So the decision has two main reverberations. How is it going to be impacting your expectations of those on the market, like what the rate is today? Supposedly, it should be of less concern of yours, rather than our trajectory, our pathway in the medium term. So it's very important to understand what the baseline assessment is, the perceptions of the members of the board, the communication that we have produced and disseminated, and that all ultimately impact your perceptions and actions of the central bank. So we're kind of using different indicators, trying to understand the situation, but to our understanding, the best way of perceiving this is communication. Direct communication for us to understand what you want, because in all these indicators there are components of uncertainty which definitely hamper the clear understanding of those expectations. If you want to share your expectations specifically and tell us how or to what extent the situation has been changing, that would be great. Well, our expectations in fact concord with yours. But the thing is that we're also looking at the trajectory of your decisions. The market does the same. Say, if you're trying to see what the market processes were before the events in Iran, then there are losses of trade potential, trade capacity, and then after you made the decision, the market immediately went in a different direction. This means that there are certain risks, that your decision could have been a little harsher, and in this case, we see that the market participants are not exposed to this risk. They are neutral, and the rate goes down. So the results of our inquiries, since the results of our inquiries were related to a certain interval in the changes made, this definitely produces a bigger signal in trying to understand how the market changes. I'm trying to understand whether the results of these inquiries could become interactive somehow, more accessible for the market players. Well, we will do that. But if there are any specific tools we can introduce, then kind of make the market more liquid with different tools that might be, in fact, the direct response to those expectations, like more transparency and more transparent transactions on the market. But I'd like to say a couple of things about this round specifically. The range of scenarios A and B shrunk slightly, in our opinion, because of certain events on the local market and external market. I mean, these events then expanded that range, both on scenario A and B. But general, in average, the tone, the diversity of the scenarios is more growing, kind of, approaching the horizontal axis, because what happened before and what happens now are slightly different. So not responding to the previous scenario and not responding to this scenario are different non-respondings. So we want ultimately to produce the signal that there might be some deviation from the curves that you perceive, that you expect. This is not a forecast. We are definitely going to be receiving new data, but we wanted to emit that signal for the colleagues who would be more skeptical regarding the inflation-related accumulations. Now the risks are more kind of growing proclivity. We have to get prepared to that step and understand that it is also possible. It might go up, or maybe not drop for a long time. So we've been looking on transactions that have been contributing to growing curve. And maybe a little bit about the role of these verbal interventions by the central bank, dear friends. In such situations where there is a need for a lighthouse, when you are thrown by waves in the ocean in different directions and the curves jump and drop, and internal risks and fiscal risks and rates in other countries plummeting and surging. I mean, we will all have to do the estimates cold-bloodedly, turn these into empirics and explain and tell people that we see them. We do not ignore them, all the risks, I mean. At this moment, however, this is the catch that we have, and we think we have to continue this way. As Vazgen just said, the market will then produce its own signals and tell us about its expectations, and then we will come over and start reflecting. The situation is not that turbulent either. Well, you know yourself, it's not. Related to the war in Iran and the risks emanating. There are serious changes taking place in the world, geographic, logistic. And there are very, very few scenarios, fortunately and unfortunately for us, that shift the situation in unpredicted directions. But I'd like to once again, with all certainty, state that we are closely monitoring, and we are there sitting tight and looking at the situation, and there are certain questions related to scenarios A and B, and that's where we are. But we're not constrained to expand. We're sure that we will never let it out of control. And it is in our framework, and you have been, by the way, witnessing those steps in 2021 and 2. We were making big steps upwards, then downwards, and we did the same during COVID. Whenever we saw that there were certain vectors, powerful vectors, of accumulating risks towards A or towards B. That's where the balance is at this moment. Yaram Madatyan, Cube Invest. My question is more about the refinancing rates, transferability. Okay, so last year and before, the repo in the Armenian banks was larger than it is now. Now it's 30 to 75. Well, I'm trying to understand. Have you been considering those scenarios? If it's zero, the mechanisms of transferring. I mean, wouldn't the impact drop? Have you discussed that? And do you have any tools you're planning to use, or any sequence of steps, so that the impact is kind of more accurate? Well, I understand what you're saying. This is an important question. We're not that concerned. It might go zero, might become even positive. I mean, the liquidity of the banks, given certain actions to be taken with no need to look into AMD liquidity. But in this whole period of time, we haven't had any situations where the repo rate towards the operational target would be significantly deviated from. Well, we may point to certain experiences in certain countries with a much weaker monetary capacity, with 3 to 4%. And I mean, we don't have the task of dictating short-term rates on our market. Well, of course, the market decides. But deviations from the operational target for us is a KPI. We've been following it. We have not seen, I mean, we don't see any issues here. If the repo window is small, it won't work at all. No, well, it's a different situation. Well, of course, 2 billion is different than 50 billion, magnitude-wise. But the level of the rates has to be perceived on a path, in a vector. It's very important, because medium term, you are going to be financing your debts, leverages, interbank value of money based on the interest for the coming years. I mean, this monthly rate is not going to be changing a lot in your profit functions. So, I mean, we are not going to be changing anything seriously because of that to increase the repo window. I mean, we're not going to be changing the architecture. That same window keeps growing and shrinking. There is no such point on our agenda. Thank you for your answer. It was just interesting, fully agreeable. Okay, so if it's zero, provisionally there is a situation, the CB board decides to push it 0.5% higher. I'm just trying to understand. If it's zero, then we should be having certain expectations, right? There is no other tool or mechanism. Well, there are two mechanisms, very hard ones. That's the deposit and the pawn shop repo. They're going up and down, but it's a very extensive range. These are absolutes, and they have respective impact. But you're right. There are certain guiding factors. And finally, open market functions per the procedure we operate with are different. We have that tool of the repo that we visit every week, but our tools are not limited to it. Meaning, if we, at a certain point, we say 6.5 and then it drops 5.5, or we say 7 and it drops 4. So once again, because of the pawn shops and the percentages in between the banks, I mean, we won't be deviating from the target. Mr. Frangyan had a question. One more question, if you don't mind. You said that there were expectations based on market inquiries. Okay, these are mostly reactive, right? Inflation grows, inquiries show higher inflation expectations, and vice versa. So, which are the main tools at the disposal of the central bank not to fall back from that curve? And where are the policy decisions? Because yesterday, the Australian National Bank was the first to increase. And the main argument was that banks with open mandate are more at their discretion. May we say that in this situation, the priority will be given to the growing prices by the board? Well, of course, because we are a central bank with one mandate. So being a CB with one mandate doesn't mean that we are going to be going into long-term disinflation redundancies. We had those, 23-24, by the way. Yes, 24, deep disinflation, and for the medium term, they brought us closer to the medium-term target. Before we were below 4%. So deep and long-term disinflation also means that we're far from the target. So, I mean, it doesn't mean being on the safe side all the time. And yes, our goal will be the growing price. So we have a goal. We will be moving towards it very, very clearly. So if there is alternative, I mean, we mentioned the stagflation and all the other risks adjacent there too. So in all other equal terms, we will be doing everything to reach our target in the medium term. Because we believe that given medium-term economic growth, sustainable inflation, price stability, financial stability are the tasks that are the main priorities for the central bank. That the only tasks for the central bank, and we have to consider them as our main action, so that in these very uncertain and turbulent situations, capital flows and long-term decisions are made by people based on the targets we give them, while believing the mission of the central bank to provide for financial stability and our determination to do so. So it's to a certain extent correct. Courage is required because dual mandate is very clear. Yes, the US would say, understand, yes, how hard it might be in stagflation for the regulators of the United States. So we'll do the monitoring. I'm sure we won't stay behind the curve in no situation. Well, if you don't mind, this is very important, Mr. Frangyan. I'd like to respond. But I'll give you the example of the Australian National Bank. If I'm right, the Australian National Bank started the growing curve, kind of communicating that they were going for increase, which was even before these uncertainties and this conflict, and they continued. But I'm trying to say that they had already considered those inflation risks. They were looking into those situations. They had started responding to those situations. However, it's also important that, especially with bigger uncertainties, like COVID, it's a great example, by the way, 2020. The FED revisions made in August 2020 the long-term goals were revisited based on the developments of the previous decade, based on the inference that Phillips's curve is flatter now, and there would be no impact or no significant impact on inflation. And that was, in fact, another consequence of globalization. They changed their mandate, and it was a double mandate, in fact, promoting employment and inflation on the other. So they gave the priority to full employment, specifically pointing out that they would not respond to deviations, but they would respond to deviations downwards only. Upwards. So if there is more, then they would react. And we saw what happened in 2022 and 23. Well, true it would be to say it was a little hard to understand the logic behind their decisions. We cannot clearly say that it was just a consequence. But it is also important, as Mr. Khachaturian clearly stated, that with high uncertainties and shocks, the mandate has to be very clear. It has to be understandable for the financial markets. The financial markets have to clearly understand what the mandate of the central bank is, and with different scenarios, what they have to do. Because, as Mr. Khachaturian just said, economic growth or employment, if they are not in our mandate, it does not mean we don't pay attention to this. I mean, prioritizing growing prices doesn't mean we don't pay attention to economic growth. So, if you read our communiqué, we clearly say that the central bank is clearly moving forward with that belief that it has to contribute to the well-being of the population. That's kind of ultimate goal. And we contribute to that goal by stability of prices, by stability of the macroeconomic processes. Meanwhile, if we have the task of bringing the inflation to its targets in a shorter horizon, like we have a 5-year horizon, we try to do it in a 3-year horizon. That supposes that we're trying to spend less, provide for the stability of prices with less cost for the economy. But on the other hand, it depends on other things and the response or the reaction of the central bank. So Mr. Khachaturian also mentioned that. Expectations, we're de-anchoring thereof. Usually with developing economies with shorter history, the level of credibility is not that high. In certain situations, you might be forced to be stricter, not to allow side effects. Okay, to conclude, that clarity is very important for the markets. Please. Ani Amidan, ARM Econom. Since it's about the repo and the interest rates, I'm trying to understand, or refinancing rates specifically. Are you discussing that plus minus 1.5%? And would that deviation be based on certain estimates, or it's just a probability range while comparing it to other countries? You have an issue on your agenda of revising it. And to continue the question by my colleague, if one day the repo stops working, the main tool of refinancing, wouldn't that be too big a difference for the market? Well, we have been tackling these issues time after time. There are different practices. Asymmetry, symmetry, wide and narrow, every time deciding a rate. If you have noticed, central bank also looks into that decision. So traditionally, at a certain point, based on different practices, we have been coming to the point where there would be no need to change for quite a long time, over 10 years. So currently, well, yes, we have that on our agenda, discussing probability of some changes in the model, but I wouldn't dwell too much on that because we don't have the big demand for that. Yes, we dictate rates short term for the banks in a very decent, healthy way. I wouldn't dwell on details there. Even if we do that harsher, we might be doing that to improve, bring more flexibility, ways of changing things. I mean, I'm hoping we won't be compelled to do things, compelled to shrink it too much or widen it too much or make it asymmetric. So we're more in the predictability range, kind of. And that has a value. Well, predictability always has a value. I mean, it's clear. Of course, liquidity management-wise, people have to have clear tools and have to understand those tools. And using them downwards, upwards is quite a decent thing to do, quite a normal thing to do, I mean, in order to be flexible in managing your basket. So nothing to solve there anymore. Thank you. Okay, we'll finish then. Thank you very much. Thank you.